December PCE inflation matching expectations up 0.2% month over month. The year-over-year growth rate fell below 3%. Joining us now to talk about this and that surprisingly strong GDP number, Judy Shelton, Senior Fellow at the Independent Institute. Judy, welcome. It's good to see you. I'm going to set the scene. I'm a scene setter. Roger Altman was on, said we figured out it was transitory all along, so maybe the Fed didn't have to go up 500 basis points, but it's good that they did because to normalize rates, but even those increases didn't hurt the economy, which means unemployment didn't have to go up for inflation to come down. And that's been a long-standing thesis of yours, that in fact, unemployment, when it's low, actually helps inflation. How's that?
I appreciate your framing it that way because I have not been one of those economists who kept predicting recession. I have been saying that low unemployment is not inherently inflationary. Economic growth, especially if it's productive, is not inherently inflationary. And so I've always thought that it was really a matter of not cutting off growth and trying to suppress demand, but rather allowing supply to equilibrate with demand, which was strong. And that would be a better model for fighting inflation. I think the problem for the Fed now is in order to maintain credibility, they really have to disavow the former model, which said they had to have restrictive rates. They had to impose high interest rates to cut off growth, to risk higher unemployment, and to suppress demand. And it turned out that was not necessary. And in spite of the high rates, and I'll go to your point about whether those are really high or not, supply came through. So that speaks very well of people working productively. It was a bad thing when we had zero interest rates. And maybe that should tell us the real lesson should be that government monetary stimulus has really been oversold. I don't think that ever did anything good for growth. And this elusive neutral rate that Steve Leisman talked about this morning as being very important to discover. Why not let the market discover that? Why not let the demand and supply for loanable capital determine interest rates? Then we'd have a natural rate of interest. And I think that would be much more efficient than the Fed ratcheting up, ratcheting down, and credit markets living in this month-to-month perils of Pauline, wondering what the Fed's thinking, when instead, really, the Fed should just step back. The Fed should not be such a prominent presence in financial markets. And I hope that's the lesson that's been learned.
We somehow, I don't know how you characterize this growth that we are seeing. Is it, if it's not Keynesian and if it's not from all the fiscal spending, is it actually organic growth? Is it happening in spite of some of the things that we've seen done? How did is productivity rising in spite of our best efforts to mess things up?
Well, I think we don't know now what the impact of AI is. Certainly there are great expectations there. But I am concerned that it's not all organic. The problem is when you have this anomaly of fiscal stimulus in terms of deficit spending by the government at the same time that your central bank is practicing monetary rectitude and saying we're going to keep it high however long it takes to keep inflation down, what that ends up doing is shifting power to the government away from the private sector. Because when borrowing costs are relatively high, that's a real barrier for private borrowers, for small businessmen, for entrepreneurs, because they say that's just an expense of doing business that makes it prohibitive. I can't expand plant and equipment. That's why I don't want the Fed to interrupt that, because that's how you increase output and bring up supply to meet demand. But I think the demand is being fueled by government spending. And I will never believe that the government spends money or makes better investments in the private sector. I think we would have much more innovative responses to issues, including cleaner fuel, if you allow the entrepreneurs to proceed and I mean, necessity is the mother of invention. And I think that's a great strength of the American economy, that and competition and the profit motive. Those are all good things that bring more prosperity in the end.
We did have the Fed kind of enable the government to overspend, and yet things are still pretty good, 3.3%. Is that surprising to you? That's what I'm trying to get at. How did that happen?
Well, I think I'll say this. If the Fed's idea was that these restrictive rates were cutting off growth, does that mean they really believe we would have had 4.9% in the third quarter or 3.3%? It would have been even higher? I don't think so. I think there's a natural resilience in the American economy. And so to that extent, the fact that people wanted to go back to work, the fact that the labor market was fairly tight, and I think continues to be, people are spending. Some of that is going to dissipate. But I will always bet on the American economy. I think there has been some genuine growth. But again, that fiscal spending, the impact of the government is dangerous, because then it's artificial. And I think that leads to more instability. We don't know how long this could last. We see a buildup of credit card debt. We see other worrisome trends developing. So we need less fiscal and monetary stimulus. And let's have that kind of organic growth that we can count on.